Good morning. It's Jeffrey Christian. It is around 9:30 here in New York on Tuesday, the 30th of January. Gold is trading around $2,054 right now, between $2,047 and $2,058 this morning. Silver is trading between, say, $23.15 and $23.40. Pretty much where they've been, maybe toward the high end. I want to talk today about the economic and political environment, and I want to respond to a few comments and questions that people have asked me to address. One of them is, how do they invest intelligently in a gold and silver market that's overrun with doom scrolling and doomsday stuff and World War III and economic collapse? That doesn't quite happen. Now, I want to say gold and silver investors should be concerned about the state of the world. There are a lot of problems in society, politics, economics, the financial system, the flow of information, which has been gruesomely distorted by the rise of social media. Both domestically in the United States and in other countries and globally, there are a lot of reasons to be concerned about the state of the world and your local community. Those factors should lead intelligent, informed people to protect their overall wealth with some gold and silver. You don't move all your money into gold and silver, but if you moved a substantial portion, perhaps 20% or so, of your discretionary savings, your wealth, as opposed to your day-to-day requirements, that would be an intelligent decision. In some Asian cultures, they don't look at what percentage of your wealth do you keep in gold and silver. They look at what percentage of your annual consumption expenditures, your financial requirements, should you have in gold and silver, in case your currency goes away, so that you can say, okay, if my currency goes away, and these are countries where currencies have disappeared regularly over the last 200 years or so, I have some gold and silver on which to live. But you need to make those decisions in an environment where you're overwhelmed with irrational fears that are stoked by coin dealers and the promoters that those coin dealers pay to interview them. And you've got to find a way to cut through the thickets of chaff and get to the more accurate thing. Now, this is the chart that we update every month in our Precious Metals Advisory. And the bubbles each represent political risks or economic risks, and the green bubbles are positive for gold. They had gotten larger at times, and then they've contracted a little bit at present. As they move over toward the right of the chart, that means they have a greater impact on the gold and silver markets. And as they move upward, it's a larger probability that you're going to see these problems in the next 6 months or 12 months. This is from our January Precious Metals Advisory. Next week, we'll be coming out with our February one. And, there's an enormous list. There are all kinds of risks. Things could go wrong in the United States, Europe, Japan. Things are going wrong. They could get worse in other countries. You have all sorts of problems to be concerned about that you need to pay attention to, and you need to have a balanced view about them. Because recessions and financial crises and pandemics and other things come and go. Recoveries come and expansions come. And this is U.S. GDP. The gray areas are recessions. You can see that there were many more frequent and longer recessions in the period from this goes back to 1947, I believe. Between 1947 and 1982, we had more frequent and more severe recessions than we have had. Obviously, the 2008 recession was a big one, but you can see here, just visually, that after 1982, when monetary policies changed, as did fiscal policies, you have had longer periods of economic expansions and shorter periods, with the exception of 2007 to 2009, of economic problems. That doesn't mean that individuals are going to have risk-free lives. There will be problems, and you need to protect yourself for that. And you also have to pay attention. This only goes back to 1947. Up until the 1930s, you had no social safety nets in the United States. There was no Social Security. There was no unemployment payments. There was no way to protect people from the vagaries of the economy. There are now. And we've seen over the last half century, last 40 years, 44 years, a less volatile economic environment. It's not more volatile, and it's a lot less volatile than it was prior to, say, 1913, 1914. So how do you protect yourself from doom scrolling? Well, you got to read the right stuff. You should be concerned about the state of the world, your community, the financial system. Financial system will have hiccups. It's human, and it's got a lot of greedy, self-serving people in it. You have to pay attention to that. You need to be concerned. If you're not concerned, you're not paying attention, right? But you need to keep your expectations and concerns within a balanced, realistic boundary. Part of the solution is to protect yourself from these risks with gold and silver. And as you assess these risks, you need to have a healthy, accurately informed perspective on what the situation is and what it really means to you and the world and what you should do about it. And that's even more problematic. This is another risk that should be on that list. The explosion of inaccurate, biased information fueled by the social media, fueled by tech company algorithms, so that if you read one bad thing, it's going to give you a series of things that reinforce that bad view. You need to get on the right track. You need to get on the right side of those algorithms so that when you read something that's a balanced, honest, unbiased piece of information, you get other things that you can read. Talk a little bit about that now. How do we do it? We have a very good track record of calling the ebbs and the flows of precious metals, copper, oil, the overall economy, the stock market, bond market. We read the source material and we study the data directly. When I met Alan Greenspan in 1981, my boss asked me what I thought of him afterwards. I said, he's a really great guy. He steeps himself in the data. 1981, you had a very divided economic environment. You had Milton Friedman and the monetarists on one side. You had Arthur Laffer and the total fraud that was supply-side economics on the other side with the Laffer curve and a phony gold standard that he was promoting in 1980. You had a very divided partisan economic environment. And Alan Greenspan ignored all of that rhetoric and just looked at the data. And he would spend, I think, an hour every morning going through statistics to see what was really going on in the economy and make his own decisions. We do that. We read the source material. We study the data directly. We do read some mainstream analysts, and unfortunately, a problem with our job is we have to pay attention to what some of the quacks are saying, just so we know what they're saying. Our clients rely on us. We have clients who call us up and say, I just heard XYZ. I heard that they're going to call in the dollars and replace them with a central bank digital currency, and this is going to be devastating. I just heard that, men and women are going to have to use the same public bathrooms, and they rely on us to say, no, that's not exactly what happened. We saw this in 2022 with stories about Chinese central bank buying twice as much gold as they had bought, actually 20 times more than they had bought in 2022. We've seen all kinds of crazy things about Russia and the BRICS gold policies. And our clients pay us to say to them, no, that's not accurate. This is what's accurate. This is what's really going on. And this is how you should view it in terms of its importance to your portfolio and your wealth. We do read analysts. We read the data. We read the data ourselves, and we ask the relevant questions of informed, reliable people who have unbiased bases for their work and a proven track record of honest and accurate analysis. And you've got to find those people, and you've got to get on the algorithm that feeds you information about what they're saying. And yes, we have disagreements with some people in the economic community, in the mainstream economic community, but they are informed. I always say, it's funny because my whole career, I've been a critic of certain aspects of the banking industry and the financial markets, but my criticisms are focused on what's really wrong with that system, not this crazy stuff that you see from the conspiracy people. You got to get on the right algorithm. Once you find them, they can be self-feeding. Here are some of the places where we get information. Fred, which is from the St. Louis Fed, is just a data dump. It's no analysis, it's just statistics. And you'll notice we use a lot of Fred charts. The GDP chart that I just showed you was a Fred chart. You can go there and you say, what's really going on with GDP? What's really going on with inflation? And you can get all kinds of information. The second one is the BLS, the Bureau of Labor Statistics. They produce the Consumer Price Index, the Producer Price Index, and a plethora of other data. This link is for the December CPI report, the most recent CPI report. It's a good place to start, but once you get into the BLS website, you can spend days and days wandering through an enormous trove of data. The World Bank publishes a global economic outlook report, I think twice a year. The IMF publishes another one. The International Energy Agency has enormous volumes of reports on energy outlook. And this is from a couple of years ago, the role of critical minerals in clean energy transitions. Tremendous amount of information about the uses of metals in the energy transition and the projections thereof. The CIA has a thing called the World Factbook, which is just it's a flip book that you can go through. So those are some of the things that you got to do. The other thing you have to do is you have to avoid the doomsaying snake oil salesman. And I'll get back to the snake oil issue in a second. You need to learn how to discriminate accurate information from misleading claptrap. Ask yourself, has this person ever been right in his or her predictions? Has he or she been talking about a collapse of something, the dollar or something? You got to do this now. You've got until April to do this. Have they ever been right? Is she or he constantly looking for new reasons to support those predictions of imminent doom? And for the interviewers, who's paying them? Is this guy interviewing a disreputable coin dealer paid by that coin dealer to represent him and to funnel vulnerable, fearful investors to them? You have to ask yourself, why is that person talking to me? What are they doing? Are they selling me precious metals? Are they selling me information? Or are they providing me free information as a public service? Things you don't have to worry about. Hyperinflation, not going to happen in the United States. Central bank digital currencies, not an issue. The people who want you to be afraid of central bank digital currencies are the descendants of the people who in the late 19th century told people not to pay attention or use checkbooks and checks, because those checks, would cause problems and lead to the collapse of the currency system. Right? Digital currencies are just another transformation in the currency system, of which we've had many over several centuries. It's not a major crisis. The end of a one-year banking support system put in place when some small state-chartered banks had troubles a year ago. And that support program was designed to support smaller mid-sized banks and mid-sized banks. That program ends in April. It's not a big deal. It's not going to cause a collapse of the currency system or the banking industry. Total failure of the U.S. global economies, collapse of the dollar, the currencies being called in the Great Reset. There's so much more. You don't have to worry about those things. Now, I want to show you a couple charts here. The next big effort to scare you, I picked up on the internet, is consumer debt. Consumer debt is at record levels, and it's going to explode. Having had so many of their predictions of collapses of this or that or the other thing not occur, the promoters are searching for new ways. What can we scare investors with next? And the big one now is U.S. debt levels. Now, we don't like U.S. debt levels, and I've given some presentations recently about not only the U.S. federal debt levels, but also U.S. Private sector debt levels and global debt levels, which are much more worrisome than U.S. federal debt levels. But we try not to prey on the fears of investors. Let's put the U.S. consumer debt into perspective as an example. Here is the U.S. consumer debt. It's at record levels. Oh my gosh, it is really high. And you can see how it took off after 1980, which is one of the reasons why those recessions have become less common. Here's another way to look at it. This is your consumer debt, the same debt as a percentage of household disposable income. And you can see it's risen sharply since 2021 and the end of the pandemic. And you can see that it's not at particularly high levels. You can be afraid of large numbers, but if the world economy and people's wealth are growing, that debt level is less problematic. Now, I don't want to belittle this. The problem is that this is collective data, and a lot of the disposable income belongs to not the top 10%, but not even the top 1%, like the top 0.1% of the people. So you've got a lot of disposable income relative to debt that is being held by people who don't have the debt. So you have to be concerned because the collective data is problematic. Consumer debt is an issue, but it's not about the collapse. It's not nearly as high as it was, in past periods of the mid-1990s and going into the mid-80s and mid-90s. It's a problem, but it's not going to be catastrophic. If you just look at mortgage debt security payments as a percentage of disposable income, you can see it's even lower. Now, unfortunately, part of that is that a significant portion of homeowners have lost their homes during the Great Recession and the collapse of the collateralized mortgage obligation system. And we've ratcheted down the housing system. That's a problem that needs to be resolved by governments passing laws, changing the nature of investing in housing. And I talked a little bit about housing in a video last week. But again, you're looking at mortgage debt service payments that are a fraction of the percentage that they used to be. So it's not exactly as problematic as people think. Meanwhile, U.S. citizens hold record amounts of interest-earning debt instruments, lending other people money. Now, again, there's this gruesome misbalance, and it's that top 1% that owns a lot of this stuff. But you have any number of retirees, as well as other individuals who have certificates of deposits, bonds, notes, and bills that they're holding. And they're now earning 5% or 4% on those, whereas 2 years ago, they were earning 0.25%. So their income from their investments are actually rising. So consumer debt is a much more complicated issue. There are problems there. One of the problems is that the government doesn't seem to want to resolve any of or deal with any of those issues. But the problems are not catastrophic. So, in summary, what are you supposed to do? Well, ask yourself. You got to discriminate. You got to ask yourself, am I getting information from somebody who's reliable? Have they been accurate in the past? Have they been consistently wrong? Are they constantly looking for new reasons to predict the same imminent doom that they've been predicting their entire careers, whether it's 1 year or 10 years or 40 years? And who's paying them? Why are they talking to you? CPM Group has a pretty good record projecting markets and prices for nearly half a century. Our projections change with economic and political conditions and with market fundamentals when they're done correctly. Our largest client base are investors. Mining companies and fabricators are large. Governments and central banks are large. Less than 1% of our revenue historically has come from sell-side banks and brokerage companies. No one pays us to do these videos. We do these videos as a public service and, quite frankly, to help people know that we're out there selling our products, which are research and consulting, not metals. People pay us to be right, not bullish. So how do you avoid doom scrolling? You have to get on the right algorithm. And when you start realizing that these people have been consistently wrong, get out of there. You need to listen. You need to understand what I speak. A couple points based on something. I don't make New Year's resolutions the way somebody said last week. I do daily try to improve my behavior. And I'm living up to what I said at the start of the year. When I call these people snake oil salesmen or carnival barkers, I'm being nice to them. I'm not supposed to tell you in public how lowly I think of them. The coin dealer who rails against commercials holding short positions in the futures market, but hedges his 90,000 ounces of unsold silver with a short futures position. The expert who cannot accurately describe how metals leases work, but will assure you that they're going to blow up on people. And those hawkers that are chronically and perpetually wrong, trying to find something else to frighten investors with, pretending to be what they are not. And the financial guru who built his false wealth on $1.2 billion worth of borrowed money, on debt. Not very wealthy when push comes to shove. We have an open forum for our clients this week on February 1st. We'll do our Silver Facts and Fantasies on the 28th. We have our PDAC 20th silver reception on the March 3rd. And our yearbooks are coming down the pike March, May, and July. That's all I've got for now. I went on longer than I would have liked to, but I think it's very important that people understand how to look for accurate, unbiased information and get off that doom scrolling road, because it doesn't do you any good. It hurts you. Take care of yourself. Take care of those around you. Do something nice for us, for the world, and I'll talk to you later this week.